Welcome back, everybody. Today we're doing a deep dive into the world of Peter Lynch.
Oh, yeah, Peter Lynch.
He's kind of a legend, right? Took the Fidelity Magellan Fund
Yeah,
from like $1,000 to 28 grand in just 13 years.
really impressive. Yeah.
It is, and he kind of has this philosophy that anyone can be a successful investor.
Yeah.
And that's what we're going to be exploring today.
Yeah.
We're using his book, Beating the Street, as our guide.
So this should be good.
Yeah, hopefully it will be.
Yeah.
So get ready to unpack Lynch's core investing philosophy,
Right.
what he looks for, how he thinks, and what it all means for you as a listener.
Well, one of the most fascinating things about Lynch's approach is how he flips the script on a lot of Wall Street wisdom.
Oh, yeah.
You know, he believes that everyday investors
Right.
actually have an advantage
Interesting.
because they're not bound by those institutional biases.
Okay, so how does that work? How can you and I, without fancy algorithms or MBAs,
Right.
compete with these Wall Street giants?
Well, he argues that, sometimes less is more.
Okay.
Wall Street pros often get lost in this sea of data and trends.
Right.
But, regular people have this unique advantage
Mm-hmm.
because they can tap into their own personal experiences.
So it's not about complex formulas, it's about real-world knowledge.
Exactly. He has this famous saying, if you like the store, chances are you'll love the stock.
Right.
And, he actually made some of his best investments
Yeah.
based on his own positive customer experiences
Uh-huh.
at places like, Cracker Barrel and Home Depot.
Oh, that makes sense. Instead of chasing abstract numbers.
Yeah.
It's about understanding the companies on a personal level.
Yeah.
But wouldn't that limit your investment options?
Right.
Like, how could you possibly gain enough personal experience to build a really diverse portfolio?
Well, he doesn't necessarily say to limit yourself, but rather use those personal experiences as a starting point.
Okay.
It's more about, noticing those patterns and trends in your own life. And then you can start to apply those to the business world.
So it's about being observant and connecting the dots between
Right.
your everyday life and then the stock market.
Yeah. And
Okay.
Lynch doesn't just stop at that positive customer experience.
Okay.
He says, you got to dig deeper,
Okay.
like visit the stores,
Mhm.
observe how they operate,
Okay.
read their financial statements,
Yeah.
and even try to talk to management.
Wait, hold on. Talking to management. Like, that sounds a bit intimidating
Yeah.
for someone who's not a financial expert. Like, did he actually do that?
He did. In the book Beating the Street, he talks about visiting dozens of companies,
Oh, wow.
from small retail stores to massive industrial complexes.
Okay.
And there's this one anecdote where he talked about having lunch with some
Yeah.
executives at Union Carbide
Okay.
just to kind of, get a sense of the company culture,
Right.
their future plans.
Wow. That's pretty bold, but I guess it goes to show
Yeah.
that he was really committed to understanding. Yeah.
The companies he was investing in,
Yes.
not just looking at the stock prices on paper.
And that's really what sets him apart. It's this blend of intuition and thorough research.
Right.
It's not just like, a gut feeling.
Right.
It's backed up by investigation.
Yeah, that's cool.
Yeah.
I like this everyday investor advantage.
Yeah.
It's kind of empowering
Right.
for those of us who, feel intimidated by the complexities of Wall Street.
Yeah.
Didn't Lynch also share a story about a group of seventh graders
Oh, yes, he did.
who beat the market?
Yes, he did.
Tell me about that.
It's this amazing story about a 7th grade class
Okay.
at St. Agnes School,
Mm-hmm.
and they put together a stock portfolio
Okay.
based on companies they knew and loved.
Oh, wow.
Disney, Nike, PepsiCo,
Okay.
Topps baseball cards.
So they were picking stocks based on like their lunch boxes,
Yes.
what they saw on the playground.
That's exactly what they were doing.
That's incredible.
Yeah.
And what's even more incredible is that
Yeah.
their portfolio outperformed many professional investors.
Oh, wow.
So, it's this perfect illustration of Lynch's point.
Yeah.
You don't need a fancy degree or insider information
Right.
to be successful in the market.
That's a great story.
It is.
And it kind of shows that sometimes, the most straightforward approach
Yeah,
can be the most effective.
absolutely.
Okay, so we've got this like amateur advantage
Yeah.
and the idea of investing in what you know,
Mm-hmm.
but I'm guessing there's more to his strategy than just,
Right.
picking companies you recognize from the mall.
Yeah.
So how did he actually evaluate a potential investment once he kind of identified it?
Well, that's where his system for categorizing companies comes in.
Okay.
He divides companies into 6 groups
Okay.
based on, their growth potential
Okay.
and how they operate.
Okay.
So we're talking about slow growers, stalwarts, fast growers,
Yeah.
cyclicals, turnarounds, and asset plays.
Wow, that's a mouthful.
Yeah.
So it's like a cheat sheet to kind of understand the company
It is.
that you're looking at.
It is a framework
Okay.
for analyzing those companies.
But with all those categories, wouldn't it still require a lot of research?
Well,
Especially if you're trying to venture beyond, like, the familiar big names.
there is research involved, but Lynch emphasizes that it doesn't have to be overly complicated.
Okay.
He recommends starting with what you know and then expanding your knowledge from there.
Okay.
So, for example, he was a big believer in the potential of regional banks.
Regional banks. Why regional banks?
Oh.
Wouldn't they be susceptible to, like, local economic downturns?
Well, that's a good point. But Lynch noticed something interesting about regional banks.
Mm-hmm.
They often outperformed even those big-name national companies.
Oh, interesting.
Yeah, and he highlighted companies like Wachovia, Norwest, and NVD Bancorp,
Okay.
all of which showed, really impressive growth, even when they were overlooked by Wall Street.
So there's value in looking beyond
Yeah.
those obvious big-name companies.
Yeah.
You could potentially find these hidden gems by
Yeah.
focusing on a specific sector you understand.
Right.
Like maybe your local banking industry.
Exactly. And that ties back to his belief in the power of local knowledge.
Right.
You might be more familiar with the economic landscape
Yeah.
and the players in your region,
Mm-hmm.
giving you an edge in spotting opportunities that others might miss.
Yeah, this all makes sense.
Yeah.
But let's be honest, the stock market can be kind of a scary place.
Yeah, definitely.
So what does Lynch have to say about navigating those inevitable market downturns when everyone's screaming sell, sell, sell?
Interestingly, Lynch doesn't view market corrections as disasters.
Really?
He actually sees them as opportunities.
Wait, how can, like, losing a chunk of your savings be an opportunity?
He has a long-term perspective on investing,
Okay.
and he views downturns as a chance to buy great companies at a discount. He actually shares an example from his own life.
Okay.
During the 1991 downturn that was caused by Operation Desert Storm,
Right.
many people panicked.
Yeah.
But Lynch saw it as a buying opportunity, and he actually even increased his own investment
Wow.
in his Magellan Fund.
That's bold.
It is,
Yeah.
but it really speaks to the importance of having a plan
Right.
and not letting fear dictate your investment decisions. You have to stay focused.
You have to have a plan and stick with it.
Exactly.
Okay.
He believes in holding on to good companies for the long haul.
Yeah.
And he actually learned this through his own experience with Chrysler.
Okay.
He held on to his Chrysler stock
Yeah.
through its ups and downs. And ultimately,
Yeah.
he reaped significant rewards when the company recovered.
So it's about weathering the storm,
Yeah.
not jumping ship at the first sign of trouble.
It's exactly that.
Okay.
It's focusing on the long-term potential
Right.
and not getting spooked by those short-term fluctuations.
Wow. Right. This is insightful. It changes the whole way you think
Yeah.
about those market downturns.
Yeah.
Shifting it from a sense of, like, panic to one of opportunity.
Exactly.
Okay.
And that perspective is so crucial for long-term success.
Yeah, it
You know,
is.
you have to have that mindset.
It definitely.
And
That's interesting.
it's a journey. And
Yeah.
you have to stay committed,
Yeah, you do.
you
You do.
And that's really
And I think that's what we're going to get into in the next section a
Yeah.
little bit more about that.
right. So stay
So
tuned.
stay tuned. We'll be right back after the break.
That's good.
Okay. Okay, so we've talked about Lynch's, like, overall approach, but I'm curious about some of the specific companies that he highlights in Beating the Street.
Right.
What kind of companies, like, really caught his eye?
Well, he talks about a really diverse range of companies,
Okay.
but there are a few examples that I think are really worth mentioning.
Okay.
For instance, he was really interested in the potential of S&Ls.
S&Ls. I thought those were like a relic of the past.
Right.
Are they even still around?
They are still around.
Okay.
And Lynch saw this unique opportunity
Okay.
in the way they went public.
Okay. Why would they be an interesting investment opportunity, though?
Well, he called it the hidden cash in the drawer phenomenon.
Okay. That sounds intriguing.
Yeah.
What is this hidden cash?
So essentially, when an S&L goes public,
Okay.
it essentially doubles its book value overnight
Wow.
because of the cash influx from selling stock.
Okay.
And this often leads to the company being undervalued by the market,
Oh, okay.
giving savvy investors a chance to buy in at a bargain price.
So it's like a hidden discount
Yeah.
that only those who understand, like,
Yeah.
the mechanics of S&L IPOs can take advantage of.
It is a bit of specialized knowledge.
Yeah.
But Lynch lays out the logic in a way that I think makes it accessible to anyone who's willing to do their research.
Okay.
And he actually invested in numerous S&Ls.
Okay.
And he saw really impressive returns.
Oh, wow.
So, it just goes to show that sometimes the best opportunities are found in those less glamorous corners of the market.
It's like those hidden gems that people aren't really paying attention to.
Right.
But if you dig a little deeper,
Exactly.
you can uncover some real value.
That's a key part of his philosophy.
Okay, so we've got these S&Ls.
Mm-hmm.
You talked about those.
Yeah.
He also had some interesting things to say.
Yes, he did.
About investing in, troubled companies.
Yes.
Which sounds a little bit risky.
It can be risky.
Okay.
But Lynch believed that for investors who, did their homework and were comfortable with a higher level of risk, that troubled companies could offer significant rewards.
Okay.
He specifically looked for companies that had hit a rough patch, but still had strong fundamentals.
So it's about identifying those companies.
Exactly.
That have a real chance of turning things around.
Right.
Not just blindly betting on a comeback story.
Exactly. And he emphasized, the importance of research when dealing with these troubled companies.
Okay.
He looked for a strong management team.
Okay.
A solid balance sheet.
Yeah.
And a clear plan for getting back on track.
Right. So you want to see that they have a real strategy.
Yeah, you don't want to get swept up in the hype,
right?
Or emotional narratives.
Right.
It's all about sticking to that disciplined approach.
Okay.
Yeah. Based on the facts and figures.
Right. You need to be able to separate the genuine turnaround potential.
Exactly.
From just wishful thinking.
Right. And he actually talks about his investment in Chrysler as an example of this strategy.
Okay, didn't he hold on to Chrysler?
He did.
Through the tough times.
Yeah. Chrysler was facing some challenges. But Lynch saw that underlying potential of the company. And ultimately, Chrysler recovered.
Yeah.
And those who had the patience and the conviction to stick with it were rewarded.
That's a good example of, how a well-researched gamble on a troubled company can pay off.
Yeah.
But I think it's important to emphasize that, this approach is not for everybody.
Right.
It requires...
It's not for the faint of heart.
Yeah.
It requires a certain level of risk tolerance.
Right.
And a willingness to do, a lot of due diligence.
A lot of research.
Yeah.
Okay.
It's not just blindly throwing money at any company that's having a bad year.
Right, exactly. Okay, so we talked about S&Ls. We talked about troubled companies. But what about some of the more familiar names that Lynch discussed? I know he highlighted The Body Shop and Pier 1 Imports.
Yeah, he did.
As companies he found interesting.
He did.
What did he see in those retailers?
Well, with The Body Shop, Lynch was really impressed by their commitment to natural and ethical products.
Okay.
Which was a relatively new concept back in the early 90s when he was writing the book.
Yeah.
And he saw their focus on sustainability as a key differentiator.
Right.
That would resonate with a growing segment of consumers.
So he was kind of ahead of the curve on the whole sustainability trend.
He recognized that consumers were becoming more conscious of the environmental and social impact of the products they buy. And he saw The Body Shop as a company that was well positioned to capitalize on that trend.
Okay.
And his prediction was accurate.
Yeah.
The Body Shop experienced impressive growth in the years that followed, proving that, Lynch had a knack for identifying those companies that were tapping into those emerging consumer preferences.
That's a great example of how, staying attuned to cultural shifts and consumer behavior can help you identify promising investments.
Exactly.
Okay. And what about Pier 1 Imports?
So with Pier 1,
he
saw them as a company that offered value. And a unique shopping experience. Even during economic downturns.
Interesting.
People might cut back on big ticket items during a recession. But they still want to refresh their homes with affordable decor.
So they were kind of recession proof in a way.
Yeah, in a way they were, because they offered that affordable way to update your living space.
Right.
Even when times were tough.
Okay.
So he saw their resilience as a sign of their strength and adaptability.
That makes sense.
Yeah. They weren't reliant on a booming economy to drive sales.
Right. It's a good business model to have, especially if you can survive through those tough times.
Exactly.
It's fascinating how Lynch connected, these everyday observations about consumer behavior
Right.
to these broader investment themes, it's like he was good at spotting those patterns
He was.
that others might overlook.
And he really emphasized, the importance of paying attention to the world around you, noticing those trends,
Okay.
and then considering how those trends might translate into investment opportunities.
That makes sense. Okay, so we've kind of explored some specific examples of companies that caught his eye.
Yeah.
But I'm also curious, how he viewed the broader investment landscape. Like, what did he have to say about the whole stocks versus bonds versus funds debate?
Well, Lynch, as you might expect from a successful stock picker, generally favored stocks over bonds for long-term growth potential.
That makes sense given his background.
Yeah.
But wouldn't bonds be considered a safer option?
Yeah.
Especially for someone who is more risk averse?
Well, while bonds might appear safer on the surface, Lynch argued that inflation can slowly erode their value over time. And he believed that companies that grow and become more profitable offer the potential for greater returns, even if they come with more risk.
So it's about weighing that potential for growth
Yeah.
against the perceived safety of a more stable investment.
Exactly.
Okay, but what about mutual funds?
So mutual funds.
Yeah.
Lynch had some interesting thoughts on those.
Okay.
He warned against chasing past performance and jumping from fund to fund.
Right.
Instead, he stressed the importance of understanding the fund's investment style and sticking with those that consistently perform well.
So it's about understanding the fund's strategy and not just blindly following the crowd.
Exactly. And, it's interesting because he managed a mutual fund.
Yeah, he did.
So he did believe that mutual funds could be a valuable tool for investors.
Right.
But he also emphasized the importance of doing your homework, and not assuming that all fund managers are geniuses.
Right.
So he encouraged investors to, develop their own informed investment strategies.
So whether you're picking individual stocks or choosing a mutual fund, it's about being an active participant in your financial future.
Yes.
Not just passively handing over your money and hoping for the best.
And that emphasis on personal responsibility and informed decision-making really runs throughout his philosophy.
Yeah.
He really wanted to empower everyday investors to take control of their finances and achieve their financial goals.
That's a really empowering message.
It is.
But I can't help but wonder, if Peter Lynch were starting his investment journey today in 2025, what industries or trends would he be most excited about?
That's a great question.
Yeah.
And while we can't know for sure, we can try to apply his principles to the current landscape.
Yeah.
And I think, he'd likely be drawn to industries that are experiencing rapid innovation and disruption.
Like what?
Like renewable energy, artificial intelligence, personalized medicine.
Okay.
He was always on the lookout for that next big thing.
Right.
And I imagine he'd be excited about companies that are, shaping the future.
So he wouldn't just be looking at those traditional industries.
Right.
He'd be looking for companies with innovative products or services, strong growth potential, and a clear competitive advantage, regardless of the sector.
Exactly. And just like in the past, I think he'd also be paying close attention to those emerging consumer trends and those shifts in behavior.
Right, because that was a big part of his investment philosophy.
It was. He'd be trying to anticipate what consumers will be excited about in 5 or 10 years.
Right.
And look for companies that are, positioned to capitalize on those future trends.
This is incredibly helpful
for
understanding how his thinking might apply to today's market.
Yeah.
But for someone just starting out, it can be pretty overwhelming to know where to even begin.
Yeah, it's a lot to take in.
Yeah. What practical advice does Lynch offer for kind of navigating this complex world of investing?
Well, one of his most important pieces of advice is to develop a disciplined approach to investing. One that avoids those emotional decisions driven by fear or hype.
That's easier said than done, right? Especially when you see, all the headlines about a looming recession or a market crash.
Yeah. How do you avoid getting caught up in the panic?
Yeah. How do you not
freak out and sell everything?
Well, Lynch acknowledged that, emotions can be a major obstacle to successful investing.
Yeah.
And he emphasized, having a plan.
Okay.
Doing your research.
Sticking to your strategy, even when the market gets turbulent.
So it's about having the conviction to stay the course.
Exactly.
Even when everyone else is running for the exits.
Yeah, it's about remembering that market downturns are a normal part of the cycle.
Right.
You know, just like those long winters we get here in Minnesota.
Well, it's like that analogy. It's like you wouldn't sell your house every time the real estate market dips.
Right.
You would just wait for it to recover.
You would just wait it out.
Yeah.
You wouldn't panic and sell your stocks.
Right.
Just because the market
is experiencing a correction.
Exactly.
Okay.
It's about keeping those long-term goals in mind and understanding that, you know, the market has a history of bouncing back.
Right. It always does.
Yeah.
Okay. So keep a cool head.
Yeah.
Don't let those short-term fluctuations derail your overall investment strategy.
Okay. That makes sense.
It's about focusing on the fundamentals.
Speculation, the underlying value of the companies you're invested in, and not getting swept up in the daily noise of the market.
This is valuable advice, especially for someone just starting out.
Absolutely.
Okay, so we've got staying disciplined. Any other practical tips that he shares for navigating the market?
He encourages investors to use the resources that are available to them.
Like what kind of resources?
Well, he recommends reading company reports, industry publications, even those free stock guides you can get from brokerage houses.
Oh, yeah.
He really emphasizes the importance of understanding, you know, a company's financials, their growth prospects, and the competitive landscape.
So do your homework.
Exactly.
Don't just rely on gut feelings.
Right. Or hot tips from a friend.
Yeah, or like some random blog post you read.
Exactly. And you know, it's funny because Lynch himself, he didn't rely on fancy algorithms or insider information.
Right. He did a lot of research.
He did it the old-fashioned way.
The old-fashioned way.
Yeah, by reading reports, visiting companies.
Talking to people.
It's
like he's saying that investing doesn't have to be this complicated, intimidating process.
Yeah.
It's about using common sense.
Yeah.
Your curiosity and the resources that are available to everyone to make these informed decisions.
He encourages you to be patient. To do your research and to not be afraid to think for yourself. After all, that's how he achieved his remarkable success.
This has been a really insightful exploration of his investment philosophy.
It has.
We've covered a lot of ground from like his core principles to practical tips for navigating the market.
Yeah.
But I can't help but feel like there's still so much more to learn from beating the street.
There is.
So what's one key takeaway? The most important piece of advice that you hope our listener will walk away with?
If I had to distill it down to one essential message, it would be that investing isn't just for the Wall Street elite. With a bit of effort, the right mindset, and a willingness to learn, anyone can become a successful investor.
That's a powerful message.
It is.
And it really embodies the spirit of this deep dive.
Yeah, it does.
You know, it's about empowering you, the listener, to take control of your financial future, make informed decisions that can lead to long-term success.
And that's what it's all about.
Yeah, it is.
You know, taking control and making informed decisions.
Exactly.
So go out there, be curious, do your research, and remember that next great investment opportunity might be hiding in plain sight.
That's a great way to put it.
Yeah.
Okay, so that wraps up part 2 of our deep dive
Right.
into the world of Peter Lynch.
Sounds good.
And beating the street. Make sure you come back for part 3.
Yes, definitely.
Where we're going to continue to unpack his wisdom and insights.
More to come.
Okay.
All right.
We're back for the final part of our deep dive into Peter Lynch's Beating the Street.
Yes, we are.
We've explored his core philosophy, his knack for picking winners.
Yeah.
And even how his thinking might apply to today's market.
Right.
But before we wrap up, I'm eager to hear more about those practical tips he offers for navigating the stock market and building a successful investment strategy.
One of the things that he really emphasizes is the importance of understanding those different types of companies. And how their performance can really vary depending on the economic cycle.
Right.
Remember those 6 categories we talked about earlier?
Right. The slow growers, stalwarts, fast growers, all those.
Exactly. He goes into a lot more detail about each of those in the book.
It's like a framework for understanding where a company fits in the larger market landscape.
It's a framework for analyzing those companies.
Okay. But how does that help you make investment decisions?
Well, let's take fast growers as an example.
Okay.
These are companies that are, expanding rapidly,
Okay.
often at, 20% or more per year.
Right.
Think of a company like, Amazon.
Okay, yeah.
Back in the 1990s.
Right.
It was growing like crazy.
Yeah.
But it wasn't consistently profitable.
That makes sense. They were putting a lot of their resources into expanding.
Yeah. They were pouring all their resources into,
right.
expanding their operations.
Right.
Building market share.
Building for the future.
Exactly. And Lynch points out that, investing in fast growers can be very rewarding.
Okay.
But it's also risky.
Right.
You have to be able to identify those companies that can sustain those high growth rates.
Okay.
And eventually translate that growth into profits.
So it's not just about chasing the hype. You need to look at the fundamentals.
You have to look at the underlying fundamentals and assess
right.
whether the company has a sustainable business model.
Right. What about those other categories like the stalwarts?
The stalwarts are those large, well-established companies
right.
with steady growth rates.
Okay.
Usually in the 10 to 12% range.
Right.
Think of companies like Coca-Cola.
Okay.
Or Procter & Gamble.
Right. Those big blue chip companies.
Exactly. They're not going to double in size overnight.
Right.
But they offer consistent growth.
Okay.
And often pay reliable dividends.
So it's more of a slow and steady approach.
Exactly.
A good foundation.
Yeah.
For a diversified portfolio.
They might not offer the explosive growth potential of fast grower.
Right.
But, they provide that stability.
Okay.
And they can be a good source of income.
Okay. And then you have the slow growers.
Right. And then you have those slow growers.
Which are basically just growing a little bit faster than the overall economy.
Right. They're growing at a rate slightly higher than the overall economy.
Right.
So they can still be good investments.
Okay.
But you have to be realistic
right.
about their growth potential.
Right. You're not going to get rich quick with those.
Right. Exactly.
It's interesting how he breaks it down into these categories.
Yeah.
It gives you a way to think about a company's growth trajectory and adjust your strategy accordingly.
It does.
But I imagine there's more to evaluating a company
absolutely.
Than just looking at its growth rate.
Yeah. Lynch stresses the importance of looking at a variety of factors.
Like what?
Including a company's debt levels.
Okay.
Their cash flow. The quality of its management team.
Right. The people running the show.
Exactly. He also emphasizes, reading company reports.
Okay.
And understanding the industry in which the company operates.
So really do your homework.
Do your homework.
Don't just rely on superficial metrics.
Right. He really wants you to understand the ins and outs of the business.
Okay, so beyond just the numbers, what else should people be looking at?
Well, he also reminds readers that, investing is not an exact science.
Right.
There's always an element of uncertainty and risk.
Right. You can't predict the future.
You can't predict the future.
Okay.
And that's why he advocates for diversification.
Okay.
Spreading your investments across different types of companies and industries to mitigate that risk.
A diversification.
Yeah.
That's a classic investing principle, right?
Don't put all your eggs in one basket.
Exactly.
And Lynch provides some really practical advice.
Okay.
On how to build that diversified portfolio.
Okay, how do you do it?
Well, he suggests aiming for a mix of, slow growers, stalwarts, fast growers.
Okay.
And maybe even a few turnaround situations.
Right.
If you're comfortable with the risk.
So a little bit of everything.
A little bit of everything.
Okay, to kind of balance things out.
It's about creating that balance in your portfolio.
Okay, so we've got diversification.
Yeah.
We've got doing your research. We've got understanding different categories of companies.
Right.
Anything else that we should be keeping in mind?
Well, he also stresses the importance of being patient.
Okay.
And not trying to time the market.
Right.
He believes that time in the market is more important than timing the market.
That's another one of those investing mantras, right?
It is.
It's about the long game.
It is.
Not trying to chase those short-term gains.
Exactly.
But with all this talk of diversification and patience, it can be tempting to just hand your money over to a financial advisor and let them handle everything.
Right.
So what does Lynch have to say about that?
Well, Lynch actually encourages investors to take ownership of their investment decisions.
Interesting.
He believes that you are the best judge of your own financial goals and risk tolerance.
Okay, so you should be in the driver's seat.
You should be in the driver's seat.
Even if you're working with an advisor.
Exactly. And he provides a lot of guidance in the book
Yep.
to help you become a more informed investor.
So even if you are working with a financial advisor, it's important to understand the fundamentals.
Yeah, you should understand the basics.
And be an active participant in the process.
Exactly.
Okay. And how do you evaluate a financial advisor if you're going to work with one?
He actually provides some great advice
Okay.
for evaluating financial advisors.
What is it?
He suggests looking for someone who has a long-term track record.
Okay.
Someone who listens to your needs and someone who doesn't charge those excessive fees.
So you got to shop around a little bit.
Yeah, you got to do your research.
It sounds like he wants to empower people.
He does.
To be in control of their financial destiny.
He wants to give you the tools to be a successful investor.
Whether they're managing their own investments or working with a professional.
Exactly. And throughout Beating This Tree, he provides readers with those tools and the knowledge.
Right. He gives you a framework.
He gives you a framework.
Okay. This has been such an insightful deep dive.
Yeah, yes.
Into the world of Peter Lynch.
Peter Lynch, he's a legend.
We've covered so much ground.
We have.
From his, core philosophy and company categories to practical tips for researching companies and managing risk.
Absolutely.
But if you had to choose just one key takeaway for our listener, what would it be?
If I had to sum it up in one sentence, I would say Peter Lynch shows that successful investing is not about magic formulas or insider information. It's about being curious. Doing your research. And taking that long-term perspective.
He makes it sound so simple.
He does.
But it makes sense.
It does.
And I think that's like the most inspiring part of his message.
Yeah.
He believes that anyone can be a successful investor.
He does.
And he gives you the tools to prove it.
He does. He gives you the roadmap
to
success.
All right. Well, on that note, I think we've reached the end of our deep dive into Peter Lynch's Beating the Street.
It's been a great discussion.
It has been. Thanks for joining us.
Yes, thank you for having me.
On this journey, we hope you found it as insightful and engaging as we have.
I know I have.
I have as well.
Good.
And remember, this deep dive is just the beginning.
Yeah.
There's a whole world of investment knowledge out there.
Right.
Waiting to be explored.
So much to learn.
So much to learn.
It's a lifelong journey.
It is.
So keep learning.
Keep learning. Do your research.
Yeah.
And who knows, you might just discover that next great investment opportunity.
It's out there.
It is out there.
Just waiting to be found.
All right. Well, that's all the time we have for today.
Okay.
We'll see you next time.
Sounds good.